Good afternoon, everybody. This is Dan Hussey with LAWayForecast.com, bringing you our live trading room end-of-week recap. We're going to go over some of our charts here and try to make a game plan for going into next week, because I think today was a proof of a lot of markets, either trend continuation or reversal in some cases. We go with the S&P 500. I don't have a great support level that we've come up off of yet. So I don't have support trading, so I do see this in the S&P as a corrective B wave or X wave. Probably looking for, again, I'm still looking for the move down to 1760s, the next in the series extensions. If I do step back and I force myself to find support, I believe we're going to take a look here at what this would look like if we're holding now the extensions from this high, which was a valid 50% pullback in the summer. It just wasn't the first one. It also already traded the prior one. But stay maker new high here, yeah, we still haven't reached that level. It's really a fight to find where support is, and usually when that happens, it means it just hasn't traded yet. So currently looking at least to the minimum of a 1775 to be a halfway back of this swing. Not a level I take. Again, I'm still looking for the 1760s for downside support. But going down to a 15-minute chart and just today's levels, after the news today, there was a there really hasn't been a full halfway back long that's traded here. But we are drawing that level up at the 1790.75. Not a level I would take because of what I'm seeing on the larger time frame, but I got, you have to drop this ambush because we have now broken the full short off these highs. And but with an unfilled gap down at 1784 half, I find it very very hard for this market to rally in a halfway back long off of the current lows. Just in today's range, talk about support and resistance levels today. Today has been all about the tick. Low of the day in the tick is also the low in price. High of the day in the tick is not currently the high in price. So we still have our opening range in the S&P. Looking at bank this morning, it was a great indicator to keep you from being a seller of the S&P. It was basically bank has rallied all day. We're now up 1.62% in bank, and the S&P has been, during this whole sell-off, you can see the S&P in purple here, bank was continuing to rally. So again, bank is once again, and using tick, kept you from being on the wrong side of the market, and really kind of kept you flat today. Having bought any of the low in the ticks for the day, you had enough to get free. But those weren't trades that I was looking to take. It's been sideways inside of the range since we've opened, and really the price action all occurred and the bid began with NFP this morning, and since then it's been sideways at highs, carving out a range with our tick indicator, as well as keeping you on, wanting to be a buyer because of what bank is doing, up 1.6%, while S&P is still hovering right around 1%. I want to move to the British pound next. Stepping back to the 4-hour chart, we've talked about this level before. This extension long has hit upside targets. Same anchor new high confirms that the swing up off these this lower low, the 151 area, that's not complete, and would need a pullback into the 160s to continue its progression higher. The swing off the 158.50 area looks like it has completed. It needs to pull back into either halfway back long of that swing or into the larger 4-hour swing down at the 160 area. So coming off of highs here, we had extensions that broke. Upon breaking, it gave us a halfway back long. Let's go down to a 5 or 15-minute chart. Take a look at that trade. We defended the 6-to-1-8 line in the news snaps and traded the 50% actually before the news. Right into the news, it went to a new low, snapped up, traded 6-to-1-8 lines, and is now has turned back lower. So we have downside targets in the near term of the British pound at a 162.70, and really we're looking for what's going to take how low can this go at this point, and pullbacks to the pound could take you into at least 161.50 at the very minimum. We'll talk about what that level would mean for this market going forward, if and when we get there. But ultimately, I'm looking for that big 4-hour pullback now, which to me, seeing as the pound was kind of the leader, both against the yen and against the dollar, and the recent dollar decline, it being the leader to the downside means a 300 pip pullback in the pound is going to mean a substantial rally for the US dollar, because you're going to see weakness come into both the Aussie and the euro against the dollar, just because the dollar is getting that bid. Euro US dollar. Stefano this morning pointed out, could we have held the extension from this prior high to highs, and that is the level that looks like held support into NFP this morning. NFP snapped back right into the 163.30 support. Let's get this perfect. There it is. It has actually traded from entry to target now. So we need to do same anchor, new high, and valid hourly support for the euro, which is not now completed. It's confirming it's not completed its trend up off these lows. Now is at the 136.40. So I need to see the market below 136.20 before I become a larger net seller. Although we have run into, we are hitting equal legs resistance, and we have broken the full halfway back short, we can look for support at the 135s and be a buyer at that level now. We are seeing longs hold, and they're currently in extensions, and these extensions could very well, remember, I'm seeing this 133 level as traded, and these extensions could be what take us up to 141. So we have technically a valid pullback to buy in the euro in extensions, the full pullback at the 135s, and any dip below 133 is, in my opinion, a gift if it actually ends up going there. But in the near term, we do have a very interesting support level now at the 136.40s that should be good enough for at least a bounce to get free, as with the 135s, because we've broken both the ambush short and now this is the second in the series of extensions. A break of the 136.20s, there's no support again until 135 for sure now, and then below 134.30, then we're looking for now the support somewhere down in this range. So we've had these are our current support levels we're going to be watching into the near term. Now there is valid support here. So there's 3 support levels on the euro versus some other markets like the Aussie and the pound. There really isn't any much support until much lower. The euro still has support here at the 136.40. The Aussie US dollar, I think I'm going to cancel these shorts for the rest of the day. It doesn't look like we're going to get them. That looked like the high. So there is extension support coming in right here that should take us up into the 131 or 91.30 area if it gets there. Maybe early next week. I'll be looking to be a seller there. Stepping out to the hourly time frame, we did make a new low, so that just means that our extensions that have traded once to target, twice to target, we now need to take same anchor, new low, and it only changed it by about 5 pips, so now it's a 91.31 is technically the 50% line, and the euro here, I'm sorry, the Aussie here could get a bid from this 90.80 area up into that level. It's still valid resistance. It's just I find it risky to take at this point in the week. So please keep that in mind. But it is valid. It would be great to see the Aussie down and then do some kind of. At this point, it would need to do a pullback all the way into 90 area for it to have equal legs into there. But I am seeing this as a expanding flat here, up in 3, down in 3, and then up in 5. Actually, looks like an ABC expanding flat or WXY, however you want to count it. So 131 resistance is still, or 91.30 resistance is still valid. It's just not sure it's going to get there this week, as the dollar has come back much better bid so far. Euro Aussie, going out to a 4-hour chart here. Let that load up. Okay, there we go. Remember, the Euro Aussie has this daily support level from the 141s, 154 upside targets. It is really not given easy pullbacks here for traders. And what we're seeing continue to hold, and hopefully this can help people see the levels. Not only would a full halfway back long be valid, but we're currently holding extensions. They're drawn from this high right here on the November 21st. It's a 146.23 high. It's traded extensions once to target, same anchor new high, twice now to target, same anchor new high for a third time. Would have support now at the 149 figure, and that would take us up to 153 targets. Okay, inside of this level, going down to a 15-minute chart, we had longs begin, full halfway back long traded. That actually then began extensions here. Those new extensions traded once to target, same anchor new high. So you're going to target right there. Same anchor new high, traded again to target. Same anchor new high for a third time. Maybe front run. Either way, we've now broken the 61.8 lines. Same anchor new high of this high has broken 61.8 lines. And I am now looking at a valid, potentially valid halfway back short, ambush short off the high, as we've now broken the swing. We've broken the extensions in the swing up off of this low. So now we need our pullback into a support level that we actually have down here at the 149 area. It's a valid 4-hour pullback. Of course, you know, you have support down at 146. If it ever gets down there, that's a long ways off. You know, I'm going to put up in this market the halfway back long of this prior swing. It's not a level I would take, not without a break in shorts. But you never know. These levels sometimes they do end up holding, particularly when a market starts to break out. Holding this level, this type of 50% level, again, not a level I would take. Holding the halfway back of this swing would mean we would be looking for new extensions drawn from this high. That would take us up into the 154s. But we'll worry about that when we if and when we get there. Just accidentally deleted this. There it is. So again, still looking for, you know, basically just looking for what's going to take us higher, particularly into that 154 level. And at this time, I see the best buys down at 149 and 146. Both could continue us into those levels, and looking for a potential little micro short here off of highs that could trade us trade into there. The 10-year futures have traded into their into full shorts here, off of lows, really looking great. I mean, this is a continuation here. And when we're looking at the continuous contract, we talked about this, how we had this neckline. The neckline's broken. We've hit the downside targets of the neckline. We broke the full longs off of lows, right? And now we have valid full shorts off of highs, so 125.28 should be resistance here in the March contract if we get there. But we are selling off now from, you know, more aggressive lows. We're continuing the trend down that has just continued in a series of shorts here. And this is the next in the series that is traded. We're watching also extension shorts drawn from our lows of 11.12 anchor to lows. So, you know, there's a nice resistance zone that we've run into and are currently holding, and anticipate, you know, holding this range into anticipating holding this range, this resistance area, you know, going forward into next week, which ultimately has aligned with a bid in the dollar yen. So we were looking to get long the dollar yen in a full pullback. That could happen next week. We've broken the full shorts, really shattered through them. We're holding extension longs. There's a little micro long that traded, and no, the next in the series micro long never traded, never filled there. So when we broke out, we just began extensions, and we have upside targets of the 103.10s at this point. You know, that's just in the near term today. Take a step back at the 4-hour chart. I'm going to save my drawings here. Give me a second. this one the $yen technical. I want to load a drawing set here, which is actually, there it is. I posted this yesterday, and this was this double triangle that we've been looking at, the double triangle count. And so far we have, and let's look at, I'm going to bring another study in here. I'm going to bring the double Elliott wave oscillator in. It's just basically two awesome oscillators that shows you a composite of trend here. So what we've seen now is, here's your two triangles. You can see both the red wave triangle, the divergence in each peak, the A, B, C, and then D and E is just so minuscule here it didn't even occur, didn't even give you much one, and that's typical of E. And then you have your sub. If we get down and we just look at this sub triangle, this is just one count. I'm trying to give an alternate to the both the ending diagonal and the corrective count that has us going down to 94s. You have a subset triangle. You can see the divergence in each peak of that subset triangle, and that's the brighter. It shows the lower degree of trends. What would you call that? Momentum as well on this double Elliott oscillator, and that's why I really like this as a tool. It shows you 2 degrees of trend. The red trend is being shown as your dark red and dark green, and the gray degree of trend is shown as your bright red and bright green. So we had a completion of this triangle that we saw on this wave 4 completion, or as I see it, on 1:11:7, right? And then we began our impulse. And breaking down this impulse is, I think, probably the most important part of why I see this as a wave 5 push, and how I see this is using momentum, how I really personally can only come to the conclusion that it is an impulse rather than a corrective wave structure higher. And the main reason is because of this, what we're seeing in terms of divergence in our peaks. We had a 1, 2. You can see easily a red peak 1, right? This is your wave 2 pullback. Then we began a new 1, 2. This is your wave 1 high. I mean, you could break this down slightly slower, bring the 1 and 2s down, but it's the same idea. The idea here is that our wave 3 of 3, that's the important part here, high, is right here. This is the wave 3 of 3 of 3, and this is the wave 3 of 3. See how the wave 3 here ended, or it's the wave 3 of 3, right, of red degree 3. So wave 3 of red degree ends here with this diverging top, right? So this is your 1, 3, or I'm sorry, 1, wave 3 of 3 top, and wave 5 of 3 top. Thus, this pullback here was your wave 4, and now we're looking for that one more push, potentially to end an impulse up to into this 104 area. This next push, while it could be terminal for and then we'll get a larger wave 2 pullback here. We don't have. You can see the wave structure probably of the lower degree here best. You have your wave 1, 3, and wave 5 waves, and that's of this gray 1, 2. It's your wave 1 high. This is the wave 3 of 1. So really, I think this needs to come to look at this in a smaller subset. You've got 1, 2, then you've got 1. Wait, let me think this through. Yeah, so you've got 1, 2, 3, 4, 5 of wave 1. So you've got wave 1, 2, and then of wave 1, you've got 1, 2 happened in here, 3, 4, 5. Yes, that works. Because now you've got your wave 3 of 3 of 1 high. You've got your wave 1 high, which is actually diverging top. So that'd be the 5th wave. So you get this, in any momentum, you get what looks like this. Let me bring up my drawing tool here. your wave 1, then a wave 3. So it should look like this. And I guess I can't use that drawing tool. It erases too quickly. I don't know why it does that. It's all right. I'll do it like this. In any 3-wave structure or 5-wave structure, you should get a move that looks like this in the oscillators. And I'm using this, and of course wave 2 can, be dip in too. But the idea is that you get, this is your wave 1 completion, wave 2 or 3 completion, and wave 5, wave 2 and 4 here. And so what we have here is and what I'm seeing in the momentum is we have a completed 3rd wave, and we need basically this to complete our 5-wave structure, because this is all the wave 3 price action, all of this wave. So we don't have this diverging top after a deep wave 4. So you can see how you have your wave 1 and 2. Your wave 2 happened here. So this is your, technically speaking, you can barely see it on here. You really can't see it, but there is a wave 1 that occurred in here. This is your wave 2 low. This is your wave 3 of 1, wave 1 high of a lower degree. So this completes some wave 1 up. The point being is we don't have that diverging top yet. We need one more high to give you, now, if this is our wave 4 low, which is also holding both extension support at the 101.90s, as well as our prior highs here at the 101.50s. We need the completion in this wave 1, 3, and now a 5th wave, kind of that diverges on this cycle. And I think if you were to move down to the hourly chart, you can see it a little bit more clearly. Yeah, this is all wave 4. Let's look at it on the hourly. Let's see. Wait, no. Drawings, delete all drawings, trend lines. Yes, okay, good. So on our hourly chart, we have here, this should be the completion of, either way, this is the completion of wave 1 here. This is your wave 3 of 3 top. This is your wave 5 of 3 top. A wave 4, a wave 5, and your final wave 4, 5. So there's actually, I think I need one more subset, it looks like, of degree of trend. So the 3, 4 fits, but there's actually a 1, 2, 1, 2, 1, 2, 3, 4, 5, 4, 5, 4, 5. So I'm missing 1 degree of trend. So this is technically, shift some of these over, but it's effectively the same. It's just how you break up this subset, and that's what that's looking like, because this is your wave 3 of 3 top right here. And then there's a wave 4 of the lesser degree, then the wave 5 of 3 top, which is fine. This is all labeled correctly. It's just the 1, 2s are a little messed up here. This is actually 1, 2. And there's actually a whole subset, 1, 2, 3, 4, 5 inside of this level. Could also be some other 3s and 4s, but point is now we're finally getting, you see this high that's coming up on the hourly. We're actually getting this high that we can now diverge what is this. This high, so long as this wave 5 high doesn't puncture the highs of this of our wave 3 of 3 here, we are looking at the divergence in a 5th wave top. If it actually shows stronger momentum, gaining momentum, that means that the only thing I can come up with here is we're going into some kind of extended 5th wave, and that we have not hit a wave 3 of 3. But like I said, hopefully this is cleared, in my opinion, has cleared for me up what we're looking at going into today, and how I use momentum. And what we're seeing, in my opinion, is that final push. in a, I mean, it all depends on where divergence occurs. There's lots of other, you know, things that could happen here. If we do turn over and we end up breaking down, you know, we could have, again, we can't deny the fact that we've run into now, you know, equal legs here in W, X, A, B, and C of a Y. We are running into that high. Can't deny that. But, you know, it is what it is. Just looks very strong for in the near term. A little too strong for this not being the, you know, a continuation of trend. But we'll see. These lows could, you know, you could head all the way up to 107, 106s. It could happen. We could, you know, this could be part of a much larger, an X wave of a larger correction. If, you know, we find the top here and we turn completely over, then we're looking at, you know, downside support, which I think is also important to remember. This could be part of a larger ending diagonal, as Eric is now looking at. You know, up in 3, down in 3, up in 3, then down in 3 here, I think would take us down into, you know, the 98, 97 region, which I think would hurt a lot of people. That's, you know, I think 98.50s looks like the next big support, or very potentially 150. So, you know, if we go below this week's low, which is a support level we've held that has valid upside targets of the 104s, below this week's low opens the door to those levels. And that's why we were talking about, and we've been talking about, you know, this is the area to be a buyer for at least that move up into this area. So if you were long, this is a good place to be taking some profits, because you know that the counter side of this argument is that this is going to be some kind of top, whether it be a new high here or right here, you know, some kind of top for some price movement to the downside to either want to, you know, it's not a place to sell it, but there could be a larger correction in play. And that is definitely something that we need to note. At this time, however, we definitely still see some longs holding, and this could be straight up in extensions. So that's all I've got to say about the dollar yen at this time. I'm still bullish it. I'm still holding my longs and trailing stops now. Euro yen. With that being said, I think a 101.40, 101.30 area is a good place to, you know, trail your stop to, if you are long from much lower. Euro yen, very, very complicated here. It's looking like we're beginning new extensions. Let's actually go out to a 4-hour chart so we can see what I'm talking about. There's still, of course, the potential for much larger extension pullbacks that we haven't gotten from these two larger levels. And those would be, if there's going to be that bigger pullback, we're looking at 138.30 and 134.30 support on the euro yen. It does look like, okay, so we had extensions that were holding here. Broke out a target, same anchor new high, never traded. And what we ended up holding off these lows was this anchor to high traditional. And this is actually a very similar situation that what we're looking at in like the Euro Aussie right now, is that if it pulls back into this, you know, anchor to low, low to low, or low to high traditional inside of what was a prior extension, we've broken out of technically we've broken out of prior extensions, which were same anchor new high here, never traded. So that's why we're looking at this high to now highs extension, as well as just in the near term, you're looking at a highs to highs extension for today's price action. So major support, the support I'm seeing now, should come in at the 139.50 area, and then really below that we're talking 138.30. Still, if you notice, we're still only looking for support in these markets. We're not looking to be sellers in a rally, because you're getting steamrolled when you do that. Momentum here has been picking up as well. And stepping out to a daily chart, which I haven't in a while, this is, I mean, this to me, what looked like some kind of ending diagonal is now looking more and more like some kind of nested 1-2s, and we're in some serious move higher for the yen. This could be a capitulating top, where you gain momentum and all of a sudden it breaks and that's it. But in my opinion, we've now blown out of projected ending diagonal levels. Like, we've gone too high in this fifth wave for this to be an ending diagonal. This has to be something else. And I'm looking at this now as an extended fifth wave. You have up 1, 2, 3, 4, and then this actually starts the 1 and 2 nestings for an extended fifth wave that can I forget what the rules are for extended fifth waves. I'll have to relook them up, but if we began, it looked like we began the fifth wave cycle from these lows, and so now we're looking, if this is an extended fifth wave, we've got up 1, 2 of a major degree, and we're in some kind of wave 3 of 3 of 5, which could target higher before a larger pullback, and then the completion of a top at some point. But unfortunately, this has gone from what we saw as like some kind of ending diagonal potentially into now this extended fifth wave, and we're in that 3 of 3 of 5 right now. That's the only thing I can see in terms of Elliott wave what this could be. So gaining momentum is definitely not bearish, unfortunately. Again, it could be a capitulating top, but look for the dips, buy the dips still. It's very much still the case. Aussie Yen, I see it now rallying into another full halfway back short. That's it. I made it purple. It's a valid sell, but I made it purple because so you could easily determine it from others. There was a full halfway back at the 93, really the 94 figure. Its downside target's the 91.40 fives, and this full short now actually has a downside target. We'll make it purple too, just so you can easily see it at a 90.80. So now we've trading in the 93.75s and holding them as resistance. Now we're talking about that resistance area taking us down in a short down to 90.80 to 91.40. So again, this 91 level, there's now lots of support from shorts. In other words, the shorts should be covering longs in that area. Plus, you've got downside, equal legs at the 91.20s, and you'll actually have equal legs here in a smaller degree coming in. If we find resistance back up here, now equal leg support will come in again down at the 90.90s. I'm not drawing that up yet until we have confirmed top, but this 91 area is looking like a major area of confluence, and what is definitely a correction lower, no doubt. Definitely a correction down into this 50% area is what we're seeing as just really big support. So we're getting ready to and getting prepared for that level to hold. It's just not yet. Just don't be a buyer yet. This rally here looks like short covering. It looks like it's just residual yen strength, but ultimately, if we remind ourselves of what we're seeing in the Aussie US dollar, there's still shorts. That particularly in the 91.30 area, Aussie Yen and Aussie US dollar heading up into their respective Aussie resistance. And I'm sure if we went and looked at other Aussie crosses, we'd find very similar setups. We're heading into a resistance zone. That means that there's the Aussie Yen can come down based on Aussie on Aussie weakness alone, and not just and probably trump the yen strength here. So that's a new high in the tick for the day, by the way. New high in the tick. But we're also making a new high in price. So lows of the day were the low in the tick. Now highs of the day are the high in the tick. Bank is up 1.7%. S&Ps are now up almost 1.10%, 1.1%. What a day. What a day. What a day is for sure. See, I think I've covered everything now that I wanted to cover. So it's a lot to do, a lot to think about going into this end of week. But today I'm thinking we're seeing some confirmations of not only certain counts, but certainly markets that, and now we have bullish divergence. We're going through the high in the tick already. So one final thing to leave you with is I've been looking at and tracking the correlations between the dollar yen, the 10-year, and the S&P, and it's actually it's unbelievable what we're kind of seeing here. And give me a moment for it to all come up. We bring it over. We did talk about this morning. There we go. Talked about this a little bit this morning, but you know, I've been watching very closely these three, and it's so fascinating to see them all moving together because S&P, which is the S&P, which is blue here, and the 10-year, which is purple. It's actually an inverted 10-year. It's fascinating to see rates rising with S&P rising, and of course dollar yen rising as it should. But what to me, in just the last 24 hours, we were talking about the divergence that's occurred in, and I'm going to line them up here so you can see. So we can see precisely when that divergence, you know, occurred in the dollar yen and the 10-year. We had, you know, the dollar yen here. They were together, down, together, up, kind of sideways, and then all of a sudden they split here. The dollar yen headed lower, and the 10-year headed higher. And then look what happened today. They converged right back to each other. So we have them coming back together, and the S&P then getting a bid. Once they started converging back together, and that was right here. So the divergence was for a very short period, and it was fascinating to see that the dollar yen was tracking with the S&P, and then all of a sudden, once they all decided to come back together here, is immediately when we got the S&P bid. So I'm going to continue to monitor this. This is fascinating to me to watch this dynamic play out in the market because it's looking like this carry trade, the yen dollar carry trade, is where it's at. And when I've been saying bonds are dictating everything about this market, this is what I mean. It's all about the cash, the real cash flowing, you know, out of Japan, out of the yen, into the dollar, which is obviously flowing into the U.S. market. And so I'd be willing to bet if you looked at the Nikkei is probably coming down a little bit because you're seeing very likely Japanese investors exiting Japan, moving into the U.S. here, and both into our bonds and into, Japanese lending money here in the U.S. versus, through various methods, and of course investing in our stock market because, I mean, the correlation here is staggering. That all three of these have moved very clearly together here, and I'm sure we can go and find other correlations and other forex crosses that are showing real money cash flows into the U.S. market. In other words, if you're seeing a correlation like the euro yen, you're seeing Europeans going and borrowing and then investing in the U.S. market. That's what you're seeing, when you see the euro yen carry trade correlated like 98%, I think, today with the S&P. I mean, it's incredible that you can find exactly what money and who's investing in our markets at this time. And what I think personally you're seeing a lot of non-U.S. Investors in the U.S. market, and this is probably, unfortunately, one of these is going to win out in the long term. Because I'm not sure how this daily looks, but there it is. And when you look at this daily, the correlation historically, you can see how both the 10-year and the yen moved together to a low and then have rallied together. But if you look, there's a period here that it wasn't until September of, we'll call it sometime here in 2011, where the S&P was completely inverted to these. In other words, this is the normal move, and then all of a sudden, all three started rallying together, and it was sometime in this period. I want to look back, but something dynamically and fundamentally changed, sometime here in 2011, and maybe it was one of the quantitative easing announcements, but something happened here. Something fundamentally changed that inverted the S&P's correlation with both the dollar yen and the 10-year that has caused them all to rally together. And I'm going to be doing a lot more investigation into this to try to figure out kind of what we're looking at. But I find this absolutely fascinating to see how the correlation completely inverted sometime in this portion. I'm not entirely sure. It looks like it was the lows, and I think this is actually the Bank of Japan started. The intervening of the Bank of Japan was probably the moment. It was probably these dollar yen lows when it all started swapping. You probably had Bank of Japan intervention into the currency, and then Bank of Japan potentially helping the Fed buy up of the S&P, the plunge protection crew, as it's called. So this is a game of what I'm seeing is a game of Bank of Japan versus New York Fed quantitative easing, and I'm assuming it was probably Japanese monetary policy that changed right here at the lows, or they're intervening in the dollar yen, and either through their bond market or otherwise, or directly through currencies. This is definitely where the inversion reversed, and we had all three rallying together. And this is real U.S. dollar growth because you're seeing that real non-U.S. dollar investment in the U.S. market, in my opinion. And so some interesting fundamentals to talk about, the long-term correlations here, and the correlation has always been between the 10-year, between U.S. bonds and the currency. The S&Ps has changed, and it'll be interesting. And it's not sustainable, unfortunately. At the point at which the Fed hikes rates, that's when I think you're going to see the swap of this. You're going to see, the S&P then invert itself again. And that moment of time, that trade hasn't occurred yet. We're not there yet. So with that being said, I think kind of a cool stuff to watch. It's, you can't really trade it. It's way too much risk. But, I think it's important to note what these three markets are doing together. So that being said, everybody, have a great day. Have a great, safe weekend. Going to cancel the Aussie US dollar orders for our trading room. We're still actually looking to take that short as an intraday signal, but very likely we'll be looking to enter into that trade sometime next week because doubtful we'll get it today, but we could. So have a great day, everybody, and we'll be back with you as price action develops.